And we're live. We're live, tuning in live from Singapore, right? So let's see. So today, it's going to be a very, very exciting day. We've actually got an amazing interview lined up with an extremely amazing investor, right? His name is Eugene. It's going to be a pretty amazing day, right? So again, if you're tuning in, let me see, my friends. Smash the like button, type in hello, so I know where you guys are tuning in from. Hey, hey. If you can hear me loud and clear, type in hello. Let me know where you're from. Hi, Takashi. Takashi is here. Fantastic. Our friends from Japan. Right. Where else you guys from, guys? Type in hello. Type in where you're from. Henry. Hi, Henry. Hi, Paddy, Harish Babu. Right. Jack. Hello, Henry. Kabir. Kabir from India. Kabir is following me everywhere. That's great. Right. Type in hi, guys, and let me know where you guys are from. Right. So again, we got people from India, from Malaysia, from Singapore, from Japan. Where else you guys from? Right, we got people from all over the world. Christine, hi Christine. Hi Ankit. It was great. We got people from South Africa. May, Karthik, what's up? Surya, Viju, May. Okay, we got people literally from all over the world, man. South Africa, Japan, Japan, Malaysia, India, right? The UK, all over from India. Oh, that's great. Okay, so today is going to be a pretty amazing session, like I just mentioned. Right, today I'm actually going to be interviewing one of my amazing guy who actually wrote this book called Vision Investing. All right, and we're going to be chatting about the financial markets. We're going to be talking about his story, how he started his investing journey, how he's actually grown his fund and actually trumped the market by over 180%, right? And it's crazy amazing, right? Like, this guy, he has done it simply by just investing in quality companies that really have the vision and growth for the future. All right. So I'm going to be digging his brains. Like this guy, reads annual reports for breakfast, lunch, and dinner, supposedly. Right. So I'm going to talk to him. We're going to actually find out a little bit more about investing. We're going to actually learn a lot more about how he invests and look at companies. And hey, hopefully you guys get an idea or two and actually improve in your own investing as well. So you guys ready? Right, if you're ready, type in ready. Wow, me, that's fast. Right, if you're ready, type in ready, and then we get started. Right. So let me just invite Eugene Ng to actually come, and yep, let's get going. Hi, Eugene.
Hi, Resh. Hello, good evening to you.
Good evening. Hey, Mark is actually tuning in. Mark is tuning in as well. Right.
Oh, hi, Mark.
Yeah. So again, I actually came across you basically from the post with Mark, and I thought, and I looked through your profile, and I was like, man, I really, really want to get to know you. All right. So Eugene, dude, right? Can you just give a brief introduction about yourself? What do you do? And yep, just what about yourself? A little bit about yourself.
Sure. Thank you, Resh. I mean, really thank you for the opportunity to hop onto this call. So myself, so I'm based in Singapore. I started investing about close to 4 years ago. Started Vision Capital. Really was just to invest for the better. Really, the philosophy of the firm is to invest in companies that reflect our best vision of our future. They are shaping and changing the world for the better. So that's
Mm,
really where it is. So patiently, we have already built up the portfolio. I think now, as of last count, I run almost more than 80 over companies that we invest. And I think the market has been very kind to us, especially in 2020. And we hope to continue to really just continue to beat the market over the long run. But more importantly, I really thank you for the opportunity and ready to share the book. I think the book is really important because you have a lot of listeners here, and we really want to help people to invest better. And I think that's extremely important. If they can invest better and make the world a better place at the same time, it's really great.
So, guys, for those of you all who don't know Eugene, Eugene has a very, very, very interesting backstory, right? Absolutely crazy story, right? Like, he had a life changing event that got him to look at investing and really dig deep into investing. Eugene, can you share the story of what happened to you in 2013?
Correct. So in 2013, a very young and very foolish guy, I had too much drinks at the beach club. And then that's where I decided to do a somersault into a very shallow swimming pool. So never do that, guys. What happens was that the top of my head hit the bottom of the swimming pool. And my very first bone in my neck, what we call the C1, which is the cervical bone, broke into 2 pieces. So it really broke into 2 pieces like that. And how serious is it is that if people would hang you, you actually don't die of suffocation. You die because your C2, which is the one below my C1, breaks into 2 and it kind of presses against the spinal cord, and that's how you kind of die. So the doctors basically bless me and says, the majority of most of the guys who have this injury, which what we call a Jefferson fracture, would have either died, and even if they survived, most of them would have been paralyzed. So when my physiotherapist would tell me, you truly are extremely, extremely lucky. And that's where I think it was a life-changing moment when I was given the opportunity. And what happens was that after that, they actually put 2 things into my skull. They drilled right into my skull, and I was there in what we call a halo vest down for 3 months. There was a period of reckoning, really. It made me realize, okay, I really need to treasure life. Life is extremely important. How can I do something and give back to the world? And that's really how it sparked that extreme moment, when the moment I could walk again. I could walk without my halo vest, with the stuff being drilled into my skull. I think that was a beautiful moment. And now I think it's really about just enjoying life, treasuring it every single moment. And I'm just glad, the opportunities, and thank you again for the opportunity, because life is so beautiful that way.
Wow, dude, Eugene, when I'm hearing your story, I can't help but go, like, shit, man, dude. I can just, literally, when you just said that you somersaulted into a pool and your head hit the freaking swimming pool at the bottom of the pool, shit, man, that must have been painful. Ouch. Dude, it took you how many months? You were out for nearly about 4-5 months?
Yes, correct. I think I was in a halo vest for about 3 months, and then subsequently I just been doing rehab all the time. And it took right now, actually it's still broken. So the back of my bone kind of healed. It's still open. There's a gap. So I guess if I'm not careful, my life can be taken away from me anytime. To be honest, that's how precious life is.
What a miracle, man. So Eugene, so tell me, man. So again, you mentioned that also sparked your interest with investing, and you went a lot deeper, right? So that was the first starting point. So tell us about that, right? So how did that lead to you getting into investing, and how did that spark the interest?
Yeah, I think when I first recovered, it was really about a moment of reckoning. What do I do in my life? So I was okay. Let's build my wealth, and I want through my wealth to do something else for the world. And I figured out, if you look at how most people build their wealth, typically the first one will be business, the second one will be through properties, and the third one is through investing. I'm not really an entrepreneur type, so I didn't, business wasn't my thing at the moment. And then also I was working for an employer, right? The other one was properties. Properties, you need money to create money. Singapore was a bit challenging in terms of our stamp duties, our TDS and everything. So that's where it came investing. So I said, okay, let me figure out investing and choose investing as a path to pursue down the road. And so that's really sparked my journey, and I wanted to go out there and say, okay, instead of me trying to figure out, why not go out there and learn from the best investors in the world? Figure out what's working from them, tweak it towards what works for me, my mindset, my mentality, my psychology, and then and make it mine, because that is always the best, and that's really sparked the entire journey.
Oh, fantastic, man, dude. Okay, so tell me, man. So again, that started your entire journey. So you have some huge principles when it comes to investing, some big no-nos, right? So we're talking about that, some massive rules that you don't break, right? Can you just share about those rules that you have, your entire kind of like a checklist? What's your cannot, should not do when it comes to investing?
Yeah, so I think investing, the first thing first, that's really, when I talk about vision is important in the sense it's really about making the world a better place. So when I'm thinking about companies, right? So for example, I had a backstory, which is my parents were actually divorced because my father was a gambler, and gambling kind of really destroyed my family. So for me, I don't do gambling stocks. It's a strict no-no, because for me, gambling has destroyed my family, and it's about really thinking about the philosophy. I would have certain things. So gambling, I don't do. I don't do smoking. I don't do tobacco. I don't do any sin stocks, basically. A sin stock is anything that, that is really taking money away from someone and also hurting them, not necessarily in the short term, but in the longer term. So when I'm thinking about investing in companies, it is really like this. So I can be, for example, thinking about a company, that's providing a lot of consumer beverages, but if their plastics are destroying our oceans, that is something that I would say, okay, I will not do that. So I won't do oil companies, for example, because of the pollution, of the long-term pollution and the side effects that we have seen. So it's really ultimately, when I go back down, is to that philosophy. That philosophy always holds core to a vision of how I look at for the future. Some of the other things that you say, besides other than the vision and this philosophy, will be really declining revenues, declining profits, declining cash flows. That's a straight no-no. If a company, if I see declining revenues, declining profits, and declining cash flows, it's something that I will not even touch with a 5-foot pole. Because winners tend to win, losers tend to lose. You can get losers to turn around, but the momentum, the inertia is really just much more difficult. And I think that's how I really think about it. So when I see those three things happening consecutively with no end in sight, that's why I don't do turnarounds. I don't do cyclical companies, because it's extremely hard to time when the turnaround is going to be. And that's why I also have those no-nos in terms of my portfolio. So when I'm doing it, in the investing world, there's almost 25,000 companies you can invest. But in what I do, there's probably at most only going to be a handful, maybe a couple of hundred companies that you can really, really look at. So that really narrows down the entire scope, and I know where I'm focusing my energies are, and that's the most important.
Okay, so guys, just as a summary, right? So he mentioned that he doesn't invest in any gambling stocks, right? No gambling stocks. Ethical and responsible investing, right? Very, very important to him, right? Beyond that, he mentions that any companies with declining revenues, declining earnings, declining cash flow, big no-no. He doesn't stand anywhere near a 5-foot pole, anywhere near them, right? So very, very, very important, Eugene. I love it, right? But beyond that, when you talk about gambling, right? One of the very, very interesting things about you, which I really love with regards to your investing approach, is that you do not look at investing as gambling. You don't use leverage products, right? You keep it simple. You keep it like, hey, I want to be a long-term shareholder. Share with us about why you do that, right? So you don't utilize like leverage like crazy and all that. Tell us about that and why you actually have that approach.
Yeah. So I think investing is a game of games. It's a game within games. When I think about investing, really is I think about it in two things. I think about it really in probabilities and payoffs. So it's really about, when I'm doing my whole investing approach, it's really that way. So what I do, how do I think about probabilities, right? Now, if I invest in a stock for one day, on any given day, you probably have a 52% chance of making money. Buy and sell. But when you extend that out and invest for the long term for 5 years, you actually have an 81% chance of making money. Now, when you extend that out to more to 20 years and beyond, you actually have a 100% chance of making money. Now, when you just invest for the long term and really truly invest for the long term, that probability straight away swings from a coin toss to 100%. So you're already setting the game outright, there, so such that you're investing it upfront there from the very first start. And then next, what you really want to do is to really find the companies. Of the 25,000 companies that are shared in the world, right? Only about 1% of them, which is about a handful, about 200 plus or so, they really account for the entire returns of the stock market. 0.4% for another handful, about another 500 or so, they account for about 50% of the entire stock returns of the stock market over the last 100 years or so. So you really need to focus on your energies and finding these great companies, to be really investing them for the long term, holding them for the long term, and then naturally let companies with rising revenues, rising cash flows, rising profits, let them keep compounding. And that's really where it really takes, and just take the whole thing up front. So when you really just keep doing that, I get the probabilities right. I invest in great companies. These great companies actually will multi-back, and they'll make more return. Now, it's just interesting thing about payouts, right? So I covered probabilities, that's payouts. When you buy a stock, the maximum a stock can go down is 100%. Though most of the time it doesn't really go down to 100%. It probably is between 50 to 70%, right? But the maximum big stock that can go up is actually the sky. It's infinite. There are no limits. So what happens is that because the upside has so many more times than the downside, you have multi-baggers 5, 10, 20 times, 50 times. When I invest in stocks, right, and I have so much stocks that can actually multi-bag, your portfolio actually ends up positive over the very long run. Over the very short run, I have no idea where my portfolio is going to be today, tomorrow, or the after. But I know naturally, if my companies are all growing so fast, they're doing very, very well. Naturally, rising stock prices is just I would say a consequence of how you're investing. And so really, when I think about investing, it's a game. It's a game of probabilities and payoffs. So the entire book really structures about it. So it really covers that. And now, of course, there's the mindset. The mindset is so important because when I talk about probability and investing for the long term, right? Our mindset, we get so affected by the media, by anything that causes, maybe we shouldn't be investing for the long term. Maybe the stock price is high, I should sell it, right? But that is really very different. So the first part of the book really covers about the mindset because the mindset is so important. How do we get us to really invest for the long term? So these two things are crucial, and that's really, I guess, causes a fundamental framework of how I invest as well.
Guys, Eugene, my takeaway from that very simply was this, right? If you just invest in good companies, right, solid companies with growing revenues, profits, and all that, and you take away the element of gambling, trying to predict prices next week, 1 month, right, and we invest in them over the long run, compounding just takes over, and that's how you get market beating returns, right? So I think that's a very, very simple approach, and something that a lot of people actually forget, right? A lot of times people like to have that fast gain. I think the biggest problem right now is people don't have patience, right? They want things and they want things tomorrow, right? Or hey, yesterday. But very simply, Eugene, like your method, your mindset, and the philosophy of how you approach your investments really over the long run simply just pays off. So again, very, very powerful stuff, man. Eugene, can you share with us, right? So your fund was absolutely amazing. It actually trumped the market by over 186%, right? And share with us about some of your companies, maybe, right? Like what were some of your biggest winners in your portfolio that really gave you outsized returns?
So I think, like I said, my fund has almost 80 over companies. So there's not one time I have a massive concentration in one company. But I think the two of my largest biggest winners. The first one would be Shopify. So Shopify, it's enabling e-commerce for the business to do your business online, to set up your virtual shop online for people to buy, fulfilling it through e-payments, getting it all set up, accounting, settlements, payments, everything all through. You've seen Shopify really spark in COVID-19. Shopify was riding on the e-commerce wave. The e-commerce wave has been around, over the last 10 plus years, right? Since Amazon started the e-commerce store, right? I think Shopify operates in a space that's really outside Amazon. Shopify was a space where Amazon tried to replicate Shopify, but failed to, and gave the space to Shopify. Shopify was a very interesting story because it's founder-led and founder-owned, and you realize this recurring term as well. I like founder-led and founder-owned companies. It's founded by Toby Loki. He's a Canadian. He really started off by wanting to create a snowboard store online and to sell it online. And he found out, oh my God, it is truly insane to do that. And then he started developing a platform to do that. Then he realized, oh, okay, there's a bigger market that I'm doing. Why not let me do it that full time? So he started creating that platform that he wanted to sell his snowboards. But he says, okay, let me do that and try to enable and get more people to sell that because he was doing it so well. And that's a great company because it's really, I would say, helping businesses to sell their products across borders, across the world. Enabling e-commerce. I think we have never had access, to products and services. In this case, products, at an unprecedented scale before. And what you think you learn about Shopify, I think that's extremely prevalent. So with that, there's also high insider ownership. People love working there. So I think the Shopify wave really sparked there, and that really driven. As you can see, Shopify had a period of rising revenues extremely, right? If you look at last quarter, revenues were probably growing about 98%. Year-on-year, just because really sparked by the COVID. Everyone's starting a business online and try to sell something. That really you can see rising. You can see actually Shopify now turning almost profitable. That's also where we're seeing the jump. a lot of parts of the jump really comes about typically when you're investing in companies, they're growing so fast, and when suddenly they're turning profitable. That's where their profits really grow even faster than revenues, but there's operating leverage going through. Because Shopify is a company that is scalable. When the more the revenue goes through, everything is just a platform. Profits just keep growing faster than revenues. And when profits grow faster than revenues, the market starts to take notice and the prices start to go up. Stock prices eventually start to go up much faster. So Shopify was one case, an example. The other one I would say is the trade desk. So the trade desk basically does buy-side programmatic ad advertising. What is programmatic ad advertising? So anything that is non-Facebook, non-Google, it's all programmatic. So anything, sometimes when you're scrolling on the internet, you see an ad on the sidebar. We're all sharing that. So many different content providers will put their advertising space out there. So the trade desk basically operates on the buy side. They basically tally up or face the ad agencies who then face your customers. So for example, you have a P&G, you want to place an ad on a website, right? And they're bidding for it, and they're doing it through the trade desk's platform. What the trade desk seems to solve was a problem was because previously ad advertisers used to hold the content and eventually mark it up and sell it at a higher price. As a result, this didn't benefit the advertisers who were advertising, and that was a fundamental problem that the trade desk actually seeked out to solve. Being agnostic, being neutral, and really solving it. And of course, the trade desk really wrote because everything's moving online, everything's moving electronic. You're seeing more e-commerce. The revenues have been growing. Trade desk was already profitable when we first IPO, and it's growing extremely. It's founder-led again, like I mentioned. Great CEO. Who is very visionary and how he thinks about things. So you will see recurring themes, right? Rising revenues, growing profits, improving profits, not necessarily could be profitable or could be already profitable or could be not necessarily be profitable, but really growing it faster. So I always look for operating leverage, meaning your profits must be able to grow faster than revenues at some stage. You're able to see as a percentage of revenues, you're able to see your SG&A, which is your selling general and admin expenses. You're able to see your R&D decline as a percentage. You want to see that because when that declines very fast, your EBIT margins just shoot through the roof. And when your EBIT margins just shoot through the roof, earnings just grow faster than the revenue. And when earnings start growing faster than the revenue on quarterly results, people start realizing, okay, this company is really growing very fast and people want to buy the company. So when people buy the companies, the stock price eventually rises. So like I mentioned, stock prices rising is just nothing but a consequence of the companies. These are real companies, they're not lottery tickets as Peter Lynch famously says. And so I'm really thinking about that. And also they're founder-led and they're typically, they have high insider ownership. They have very strong Glassdoor ratings, typically north of 3.5 stars or even 4 stars even. Typically, they also have very high CEO approval ratings, 80%, because you want your employees to like working at the place. When the employees like working in a company, is a natural consequence that they're giving their best to the company. They're doing well. So those trends really always normally come true. And when you're looking, I'm always constantly looking out for the trends. And of course, one important trend is, the balance sheet has to be strong. Preferably, I will always prefer that they have net cash, don't hold a lot of debt, because debt is a case when you need to refinance and you can't refinance, you're dead. We're here in the game, when I go back again, probability, right? You don't want to have debt, and when there's even a remote probability that you can go bankrupt, or you can suffer, or you can't recover from that. And that is so important because I want to remove that from the equation. So you can see constantly what I'm doing is just improving my probability of finding winners, making it higher non-stop. But founder-led companies, when they're skin in the game, they're going to do all their best because all their net worth and their wealth is stuck in the company. They are motivated. They have the same motivations with you, to really be on the same page to really let the company do well as the shareholder. So again, that is also a reinforcing effect that getting the companies to really again do better. So that's what I'm always been sharing these two companies. It's always the same themes that comes about.
Talking about vision investing, we're talking about the vision of 2020 and beyond. Things are changing so fast, things change so quickly, right? And the vision for a world that is being transformative, disruptive, these words get thrown around a lot, right? So my question to you is this: what do you find? What do you see to be the major, biggest, maybe disruptions for the vision, right, for the next 10 years or so?
Yeah. I think when you're really thinking about this, you can't be really thinking, the next like you said, right? Really thinking 10 years, thinking really, really far. I think that's extremely important. I think the way I see some of the bigger teams that are unfolding, right? We talk about e-commerce. E-commerce has been happening. Right now, if you look at, for example, in the US, in China, for example, e-commerce as a percentage share of total retail sales is 25%. US is probably about 15, 16, 17%. Southeast Asia is probably between 5 to 10% across the markets. Right? Do I see e-commerce as being 100%? No, unlikely. I think we like to shop at brick and mortar stores. We like the shopping experience. We like to see the physical stuff. I do think e-commerce will continue to rise. It'll probably rise towards, I would say, maybe anywhere from 40 to 60%. And you can think about it. Every year, the e-commerce growth in e-commerce is 2 to 3 percentage points. So we are talking about still a long runway to go, right? It's going to be at least 5, 10, 15 years before e-commerce gets to about 40 to 60% of our total spend, and when we really buy everything by e-commerce. I mean, we're already buying a lot by e-commerce, but I think that we'll see as a natural trend. And what's supporting e-commerce has to be electronic payments, right? Everything you're buying online has to be supported by electronic payments. So I think electronic payments is also supporting e-commerce, running on the back of e-commerce, and that's coming true. And the same thing, if everything's moving online, you really have to move online advertising, right? You have the likes of your Googles, your Facebooks, everyone was doing online advertising because that is supporting, that's where the ecosystem is. You see display advertising come down, nobody advertises on radios anymore, everyone's just doing online, because online is where you can track the ROI of how much you are advertising. I can actually see that comes down to how much people click through and how much people are buying. I can see the
And
ROI of my advertising spend.
and that's where companies like TDD, Trade Desk, basically prosper and
Yeah.
flourish, right? Analytics of companies, advertisings, and all that, right? So again, guys, I think one of the main points that Eugene is talking about is, we talk about online advertising, right? Talk about online advertising. What are the companies that enable online advertising? So beyond just looking at, okay, Facebook, Google, for example, like what are the companies beyond that, right? Like which goes through, data analytics, right? Like, finding out all the different data with regards to advertising campaigns. So let me just explain to you. When massive companies, when huge companies go out, MNCs go out to actually advertise, right? When they're spending millions of dollars, they invest a lot of money in other enabling companies to actually track their data, to actually give them feedback with regards to, hey, how is my advertising dollars doing? Is it going to the right places? What's my ROI on my ad spend? And that's where companies like Datadog comes in. That's where companies like the trade desk comes in to enable these companies to actually find out data analytics a lot better, right? So this is one area that is growing tremendously, no doubt about it. So Eugene, so I want to ask you, right? About, we talk about winners a lot, right? So we talked about Shopify, talked about Trade Desk being some of your biggest winners. Let's talk about losers, right? So people always like to talk about winning. What about losing, right? Talk about some of the stocks that you maybe lost money on, and what were your biggest lessons behind them?
I think the biggest lessons about losers is that you must understand in investing, you will always have losers. That is for sure. You can't have 100% winning stocks, and there will have losers. You need to acknowledge that there will be losers. Now, in the sense is, like I mentioned again, the losers will go down, right? So I think importantly that's the case. That's the case. So for me, I had two companies that were some of my biggest losers. The first one was Wirecard. Wirecard was a German, what we call a fintech company. As you can see, you'll see Wirecard probably in Singapore when you're at the point of sale paying for credit cards. You see a Wirecard terminal. So Wirecard actually acquired Citibank's business in APAC for the point of sale. For the point of sale, basically on the acquiring side. So what happens is that Wirecard was back then, I think it was 2016, 2017. A company was growing rapidly. Revenues were growing very fast, high insider ownership by the CEO. Profit margins were extremely solid. It painted all the check boxes of what I was looking for. Really, it painted all the check boxes of what I was looking for. But because it was growing and the stock price was also growing so fast, I was just asking myself, right? It was too good to be true, and of course I invested in it. But more importantly, what happens was that about a year and a half later, you saw the FT scandal. right? They started doing a lot of intercompany transactions. They had a lot of massive fraud in the case. And what happens with Wirecard was that I went back and looked at my investment thesis. For me, just to share, Resh, whenever I invest in the stock, I typically spend anywhere from, I would say, 4 to about 20 hours writing anywhere between a 30 to 80-page investment thesis. So I went back and looked at my investment thesis back then. And that's where I realized, I actually wrote down, Wirecard had a lot of intercompany transactions. Wirecard had massively a lot of small subsidiaries where they were something was buying something. And these were red flags. And I brushed it aside. And then I think it was just confirmation bias. I was seeking for great companies, and it was confirmation bias that hence I wanted to invest in it. And so what happens was that when the first FT things came about, I actually did a deep dive. I relooked at the entire report. I said, am I seeing these red flags? Are these red flags really real, right? So I started looking at the red flags, and I started looking at deep down some of the companies that, for example, they were in Singapore, which they own here and there. And I was like, okay, something's really, really weird. And if something you kind of realize, if something smells fishy, it's probably a fish. And I straight away, the very next day when the market was open, I sold out my entire stake at whatever prevailing price it was. I didn't care. Wirecard maybe bounced back like 50%, and then subsequently it went down to zero, right? As we all know. But it was perfectly fine, because for me is when I realized I got the investment thesis wrong. And it's okay. I need to necessarily know that losers happen. Losers are part of the process. I get it wrong. It's okay. Sell it. I move on. I learn from it. I learned that I never need to take off. I need to be very, very extremely aware of my confirmation bias. I need to know that when I'm seeking now ever since then, I've actually put in all my investment thesis red flags. If I see any red flags or something that I'm questioning about, or what should I be looking at, I put it in. And then I will weigh. I do not brush it aside and simply just ignore it and just write down all the good things about the company. And that for me actually has allowed me to actually reject some companies and not invest in them. And eventually, for example, I give you an example, right? This was a very interesting, it actually led to Luckin Coffee. I look at Luckin Coffee. Luckin Coffee is the Starbucks of China, right? The way Luckin Coffee was positioned was that, in the US, everyone drink so many cups of coffee. And in China, they were probably drinking like 1/10 of that, right? So if China just need to drink double the intake, this massive amount of coffees they're going to drink, and it's going to be insane. I got the story. Luckin Coffee was so interesting because I asked my China friends, is anyone in China drinking Luckin Coffee? And then they realized, they told me no. It started off quite okay. People were drinking, but lesser and lesser people were drinking Luckin Coffee. And lesser people were drinking coffee because China had a traditionally tea-based culture, and they started drinking tea. Then something was off. And then suddenly when I looked at their website, so when they first IPO, it was really a lot of coffee-based drinks, and they started with tea-based drinks. Now, if you're a coffee play and you started pivoting and started doing a lot of tea-based drinks, something's very wrong. Especially this early in the game, right? You should be ramping up your coffee, ramping up massive, right? And that's enough for you to drive your revenues. But you started shifting tea-based drinks and all. So that was another second red flag, and I was like, okay, something's off. I hesitated. I didn't invest. And of course, the whole Luckin Coffee fiasco broke up with Citron and all the other short sellers reports come out. And I looked at the Muddy Waters report, all the receipts, the invoices. So I think it was a very, very long report. And it kind of felt like it. So it was another case where I realized something that were red flags, a great story again, but it taught me. I think the other stock that I wanted to share was ITE. ITE was some position as the Netflix of China, but slightly different. It didn't operate on a pure subscription business. It operated on a kind of hybrid, an ads-based business where you had ad-based revenue, and also kind of a bit of a subscription business. They were trying to build it up. ITE, when I first bought it, the revenues were growing very fast. I think we're north of 50%, 60%, right? And they're growing very fast. And I like companies that are growing very fast. But what happens was that after 1 year, the revenues started coming down to 20%. From 60 to 20% 1 year, something's off. And the market obviously didn't like it at all. Profits are coming down and stuff, right? And I think recently, this was what happened. And I looked at ITE's earnings. Their revenues just came off, and their growth was just. And if you look at the stock right now, the revenue wasn't really growing; it was flat. And what more important was with any content company, right? They were selling the content. Can you imagine if you're a content company and your content is king, You want people to come to your platform and to be watching your platform. And instead, if you are selling your content, something's off. You need the money. Think about it. If Netflix was selling House of Cards to someone else, so that someone else will watch House of Cards on Disney platform, right? It will be just insane. So when that was the final straw, and I said, okay, I've seen enough. I've seen a couple of quarters. Generally, it takes me to at least see 3 to 4 quarters to see if the revenues are declining so fast. The business is really deteriorating very badly. And then this was the last straw, and I said, okay, I'm going to sell it right. And the next day, again, I sold it at whatever price it was, the entire stake and an offset. So the way I see it is two things, right? The way of how my losers come about is two things. One, you just got it wrong. It's okay. There are times that you get it right, and the times you get it wrong. But hopefully, the times that you get it right, the wins more than outweigh all the gains. And the other one is fundamentals. And just came down, just massively deteriorating faster than expected. So these two things really, I would say, are kind of always the recurring themes. Nothing more than that. Yeah, so that's really the case.
Fantastic. Eugene, I think you're lagging a bit, right? I think you're lagging a bit, but okay, I think I see you now, right? Okay, cool. Okay, so again, we talked about, just a summary, guys. We talked about some of his losers. We talked about IT. We talked about Wirecard, right? Wirecard was really out of the blue, right? Like, again, fantastic fundamentals. Everything was going all right. Revenues increasing, earnings decreasing, very low debt, all of it, but, out of the blue. But again, there were some red flags that Eugene actually noticed, and hey, sold out. But hey, Eugene, I want to actually ask you, how do you manage a portfolio of 80 stocks, man? Like, that's a lot of companies, bro. Like 80 companies. Like, do you find that's an okay amount, or do you feel like you need to trim it, or tell me, like, 80 companies is a lot to take, right?
It is. I think the way I think about it is, as investors, when we think about diversification versus concentration, I think an investor should at least have 25 stocks, because that way you're not affected by any single investment, even if the stock goes down to 50%. You're still able to sleep. So I think that number really is I would say specific to each individual. As your investing journey grows, you naturally get better. For me, I don't have a specific number in place. It's really about, I have so many opportunities and so many great companies just coming to me, and I'm looking at it, and I really want to invest in them. And that's really it. I mean, the most, like you said, right, the most crazy time is when it's quarterly earnings season, and I'll be like doing 10 to 15 quarterly analysis of the earnings on a per day basis, and that can get quite packed for that 1-2 months period. But to be honest, Resh, when you're doing the investing style that we do, really investing for the long term, I put in a lot of work. I get investment thesis up, right from the beginning. And honestly, beyond that, other than the quarterly earnings, there's nothing much to do, to be honest. There's really nothing much to do. So in these intermediate periods, I'm looking at new companies. When it comes to quarterly earnings reporting season, I'm just looking. It's like more of a scorecard. Okay, how are my companies performing? Are they doing okay? If they're doing okay, let them be. Just let them be. The way about investing is that you actually don't need to do anything. That's the beauty of it, and that's why seemingly I might have a lot of companies, but because I did a lot of work to really understand them right from the beginning. And then every time when there's quarterly earnings, it's just smaller tidbits of information updating you about how the company is doing or not. And that way you actually don't have to spend too much time. So you're always constantly reminded of how the companies are doing, and they're perfectly fine. And I always encourage people, there's listeners out there. I keep my eye on Google Docs, write investment thesis, why you buy them, and if anything, why will you sell them? That's always so important. When I look at that, so if I look at the quarterly, nothing tells me why I should sell. Oh, okay, I'm holding the company. And if the revenues are growing fine, it's doing well, there's nothing for me.
So Eugene, in your
the most beautiful thing. I don't look at charts. I don't need to at all.
So Eugene, I have a question. So in your portfolio of stocks, right? Your portfolio of stocks of 80 over companies, right? Like, your top few, how's your percentage in terms of weightage, right? So maybe you're the ones which are more concentrated in. How many percent do you look to put towards those places?
Yeah, so my top stock, for example, is about 11% of my portfolio. The second one is probably about 7, maybe 5, 3, 2s and stuff. So what happens is that when you think about allocation, right, it's so important because the winners, when I always do equal allocation, because to be honest, I think I would know who's the winner, but most of the time you really don't know who's the winner. And these winners became a large part of my portfolio by their own merit. They became, like, for example, Shopify was a 10 bagger for me, 10x, right? Trade Desk was a 9 bagger for me, 9x. It became there based on their own merit, based on their own reasons, because they were good. They were doing well, the market recognizes that, they buy, the stock price rises. That's really it. So I don't think about allocation a lot from the perspective. I don't have a target allocation, but sometimes when I'm buying new companies, sometimes I will do a starter stake and then I will analyze for a couple of quarters. Is the company doing well, right? You must understand this. Stock price doesn't tell you that the company is doing well. Stock price doesn't tell you anything that the company is doing well. Only the quarterly earnings, if the revenues are going well, or you have leading indicators, right? That are telling you if the company is doing well. That is more important than anything else. And I'm seeing a couple of quarters, these are doing well. I'll increase my stake. I'll move it maybe from a starter stake to a medium conviction stake, or maybe to a medium high, and then to a high, and then I'll keep adding them. So whenever I see there's opportunities, I keep adding them, because it's important to always keep some cash. I do keep some percentage of cash of my portfolio. I'm not fully invested, because cash to me extremely important buffer.
Eugene, okay, cool. Your Wi-Fi has some issues, I think, right? But anyways, right? Okay, quick question. So Mark is actually asking a question, right? So Eugene, for current research, are there any companies you'd like to warn the community about, right? Is there anything that you wanna warn the community about? This is what Mark's asking. Anything?
Yeah, so I think it's the way of how I think about it is that there are a lot of companies out there, especially IPO stocks and stuff. I think it's very important that when we're doing all this, don't get hyped up. People will talk about it. These companies are doing great. Right? I give you an example, right? It's not a specific opinion. I've just did a recent analysis, for example, into NIO. NIO, it's some will call it the Tesla of China. Now, the way of how I see NIO, right? So if you look at NIO, they have everything. They've been making cars. They're also doing autonomous electronic, and they also have the batteries on the home and stuff. But NIO is not the Tesla of China. And how I'm going to tell you that, right? One, NIO doesn't manufacture the cars themselves. They get a contract manufacturer to manufacture the cars themselves. A core of Tesla's manufacturing capability is the manufacturing. He gets it because he does everything in-house. NIO, for example, doesn't have autonomous driving. It relies on FireEye, which builds on a vision-based driving, and that's fine. But again, it doesn't have the database, right? And NIO operates only in the premium space, whereas Tesla operates in the entire space. Now, we just think about it alone. Companies that we think about, not necessarily they are necessarily the Tesla, because it's very easy to say something is the something or something, right? But we need to really go down deep into it. Look through the annual report and the 10K. And I did this by looking through in the 10K, and they will tell you all in the risks, and they'll say, this and this, right? And we look at it. Okay, think about it. Just follow my mindset, right? If you're a car company, you're not making your own cars, and your volumes are going to start by the car manufacturing company. You can never squeeze margins down, right? Your autonomous driving is given by FireEye. There's nothing special about it, right? There's nothing specific to you. You don't own a chip that does anything which is like what Tesla does. And why should you then, there's nothing really standing you out from me starting. I mean, yeah, that's how I would say. So it's important when we are doing our investing, our analysis of new companies, really just be looking out at this and try to figure out what are some of the red flags. What is something that is not necessarily what the media might make it out to be. And sometimes a lot of these companies will run up so fast and so quickly. But sometimes I would say just put in the extra work and figure this out.
Interesting, man, dude. You seem to be a guy who does a lot of work, a lot of homework into researching companies, reading the 10Ks and all that, right? So again, no easy way out, right? Again, yeah, okay, great, right? So I think there's a lot of investors right now who are listening in who are possibly new investors, right? I think new is pretty innovative, pretty disruptive, but then again, it occupies a small portion of the portfolio, so I think that's all right. Anyways, we have one more question, right? Which is this: so when you're managing a portfolio, how many percent do you actually keep in cash, right? Especially in the current market situation where you're seeing valuations being hyper extended. How much do you keep in cash, and how much are you invested?
Yeah, so I think the cash percentage, to be honest, varies. I would say between 5 to 15% on as part of my portfolio on any given time. Now, I do keep some percentage of cash, and why cash is so important, because cash acts as a buffer in the sense, more importantly for psychology. So really, sometimes when the market tanks, if the stock prices drop 50%, right, and I ask myself, did anything change? Did the company fundamentally change? And I give you an example, right? When COVID struck, right? I asked myself, Netflix was down, I think 30 to 40%. And I asked myself, is Netflix going to go away? People are still going to watch more entertainment. People are probably going to subscribe even more. Why should Netflix be down 30 to 40%? That's where moments where because you've done the work already and you have so high conviction in these companies, you know that this should be actually rock solid. And that stock price drop is actually, like I say, a voting machine in the short run. The market is just reacting, just selling everything. So cash is an extremely important buffer because it buffers your mindset. You have that ammunition, I'll call it the ammo, to invest in companies that you still have high conviction in and still expected to grow. And that's so important. So I think
Absolutely.
cash is really that buffer which is so important.
So true, so true. So again, what Eugene actually has in his portfolio is anywhere between 5 to 15%, right? Slightly about 15% or so in his portfolio to make sure that he actually can buffer and obviously take advantage of opportunities, right? So Eugene, so your approach is very, very simple. You never sell unless you find something fishy, something wrong about the company, or you find an alternative, better investment to actually allocate your money to, right? So that's basically what you're looking at. One more thing, your the companies that you're actually managing a portfolio, are they all US based companies?
No, so I would say the combination. They're all global companies. Though a large percentage of them are probably based on the US. I have US based, European based, a fair bit of Asia Pac based, companies out there in Asia as well. We have a Singapore company as well. So it is a mix.
Oh, so you invest very internationally. So even in European stocks as well. Can you give us some examples?
European stocks. Some examples will be I can say will be Adyen or Shopping or Spotify. Adyen is a payment processor that
Yep.
helps to get people to make payments, and the other one is Spotify, of course. When you listen to your music as a service.
But the European companies, Adyen is a European company. Spotify wise, it's an American listed company as well, right? So again, these are two. Okay.
American listed company, but European based. Correct. Yes, correct.
Okay. But do you buy like European shares, or just mainly American listed companies?
Mainly American. There's some European, but to be honest, not a lot. Because if you look at an interesting thing when I did my screen right at the beginning, when I remember, I looked through the entire world universe of all the stocks, and I tried to understand every single country. What are all the stocks? And when you start to look at the consequences, so you look at Singapore, for example, there's a lot of contract manufacturing companies, a lot of REITs. If you look at Hong Kong, there's a lot of industrial, a lot of property companies. If you look at Europe, there's a lot of consumer product companies, oil companies. Your BPs, your Shell. You have a fair bit of some insurance companies. You have a fair bit of some pharma companies, but technology companies that are really driving this, not that many. Not doesn't really fit a lot of the mold of the companies, but I am seeing an increasing mix. So I'm always constantly watching this space. So it's really there's no geographical focus that I want to focus on. It's just naturally if the company is good, they're in a great space that really large, I would say, total addressable market that's growing, and they can gain market share for the long run, right? That's where something I run and just gravitate myself towards. It comes to me naturally. I don't have to go and purposely try to look for something when there's nothing to be there.
Interesting. Okay, great. Right. So again, guys, that's a basic summary of what Eugene is actually sharing about. Right. Again, we talked about RDN just now. Right. Chloe is actually asking, will you invest using a leverage account? And generally, Eugene actually stays away from leverage. Why? Because dude, like he doesn't want to get into any trouble. Right. Eugene, you want to share the quick story you told us about the bankrupt thing, right? About the game that you played. You want to share with us about that and how that shaped your thinking?
Yes. Correct. So when I started my investing career, when I started my investing journey, I had this game with 8i. So 8i and Kenshi, I played this game. So this was a stock market game, a virtual game, as you can call it, in 10 rounds. You're able to borrow as much money as you can, and take as much leverage as you can to buy stocks. So thinking I was a great guy and investing for the long run, right? So what I did was that I borrowed all the leverage and bought all the stocks. And I was fully invested in the stock market, right? So the first round, the stock market was up 10%. I was the number one winner of the entire class, as you can imagine. This crazy guy, right, going all in. The second round, the market was up 20%. I was like the biggest guy. People interviewing me. I was getting all the hubris. I was feeling really like I'm the most amazing guy in the world. I'm the most amazing investor in the world, right? And the third round, the market fell 50%. The moment when it fell 50%, because I was leveraged, I think the game was 10 times, I was wiped out straight away. And that was the power of me realizing at that point of time, I was at the top, all proud and all thinking that I'm great, and I was brought down to my knees. And that fundamentally, thankfully, it was a virtual game, but that virtual game taught me so much lessons that leverage is something that I will not do. Because when I go back to my team again, right, it's about probabilities and payoff. If I get into leverage, though there might be a low probability that I will be wiped out, but when I wiped out, I get wiped out. Investing is a long-term game. You are there to stay in a game and not to be wiped out, because once you're wiped out, it's very hard to continue. So I'm trying to just basically remove any probabilities of me losing everything. And so when you take out leverage, you totally just remove that probability of you not losing any money at all, or totally getting money. And that's why the game was so instrumental. And I say that was probably the most important takeaway into shaping my mindset. And I'm hoping the listeners as well, that experience, is so instructive to you that hopefully you don't try to repeat it and experience it yourself. You don't have to experience it yourself. You can experience it from someone who has gone through it, and that hopefully that helps you in your investing journey.
I want to share with you guys, for those of you all listening, I think my biggest lesson from Eugene is this: stack the probabilities in your favor, right? What are the things that will get you to win? And what are the things that will move you away from your goals? Right? What will get you to win is companies that are solid fundamentally, that are growing its earnings, growing its cash flows, growing everything, right? That's number two, investing in it with a long-term time frame, right? Instead of thinking about it, once or twice, thinking about it from long-term time frame, right? And stack the probabilities against you, right? So again, things that can actually push you back like crazy, right? When you over diversify, put everything into one company, or let's say, for example, when you leverage tremendously. Okay, again, for Eugene wise, it's a strict no. I don't over leverage. But hey, that's stuff that you got to take note of, right? So again, there are many guys who are listening who just started out, right, and they're leveraging like crazy, and yeah, sure, they made a lot of money, but you never know how one black swan event, another one event where the market pulls back 30%, 40%, and boom, you're back to ground zero. Right. So again, that's something that is very, very, very important, right, Eugene? Right.
Yeah,
so again,
Resh, if I could share a bit more just on other than, sorry, if I could share a little bit more just other than leverage, right? It's about options as well. So options is, again, if I'm buying options, that's fine. But if I'm selling options, right, and if the stock price drops, but if I'm selling options, I only have limited upside because I'm collecting the premium. But if the stock prices drop, I can lose a lot more because I have unlimited downside. So that's also something that I don't do or sell options, because again, it's like what you said, like probabilities. I don't want a case where I have unlimited downside and I have limited upside. And yes, maybe probably 80%, 90% of the time you probably make your option premium, you earn it, and it's great returns. But when you have that 10% of the time and you get a full drawdown, it will be very extremely painful. So again, similar to space of leverage, not just taking leverage to just buy stocks outright, or sell stocks outright, but also taking leverage via options. It's also something that we also don't do here at Vision Capital. More specifically, I would say selling options, because selling options, you're totally getting the payoffs against your favor.
I think one of the things that is very, very important, guys, is this. One of the things that is very, very important is to make sure that it's cash secured, right? Which is what we always teach our people as well, right? So again, if you want to,
that is okay. That is fine.
Make sure it's cash secured. Make sure you actually do have the money to actually go and buy it, because
Yep.
if you're doing it without being cash secured, then it can be very, very dangerous. It can wipe you out, right? So again, just word of caution to everybody. Anyways, Eugene, thank you so much for sharing. We've been sharing quite a lot with the audience, right? I think I just want to thank you for taking your time out to actually come and share about your winners. And again, guys, this was basically how Eugene trumped the S&P, right? Essentially, by investing in great, solid businesses. He shared about his market trumping returns using with Shopify, with TDD, with a whole bunch of different companies, and investing in them over the long run, right? And dude does a lot of work with research into companies. Anyways, Eugene, what is your one last parting advice for any new beginning investor who's actually worried about the market being so high right now? Right? If you are, they're looking at it and they're like, oh man, everything is so high right now. Should I even be getting in, or should I wait? Right? What is your advice to them?
The one advice I would say is this, right? Stocks always go down faster than they go up, but stocks go up over the long run more than they go down. That's extremely the way to think about it, because when I buy a stock, I don't place orders. I just buy a market, because even if the stock goes up by 5%, I am looking for 5, 10, 20 baggers. The price of 5% higher really doesn't matter. But I'm not trying to say, you go out and go out and use all your wealth and buy everything, right? I think when you have done your homework, you have developed that conviction, you think that company is a great long-term investment that suits your portfolio, there's for your vision, buy a small stake. I usually do the rules of thirds, right? Buy a starter stake. You like it, next quarter the earnings are good, it's playing against your thesis, add a second stake, right? Do a third stake. When you have companies that are going to be 3 times, 5 times, 10 times, you have plenty of time to buy the companies. You don't have to rush. You don't have to rush and buy everything up. Buy them over time. I never take a full stake in a company at one time, because there's always no need. I let them prove to me that they're worthy to have a place in my portfolio. So let your investments, let your stocks prove that they have a place, and you add to them over time. So I would say close with this, right? I find this is from my guru, which I learned a lot of my investing from, David Gardner. You find excellence, you buy excellence, you hold excellence, you add to excellence, and you sell mediocrity. That's how we invest.
I love it, right? Fantastic ending quote, right? Add to excellence, sell mediocrity, right? Add excellence, sell mediocrity. Absolutely amazing. Okay, anyways, guys, I just want to share with you all, right? One more time, Eugene actually wrote his book, and the book is Vision Investing. You can actually have a look at this book, right? So again, how we beat Wall Street and how you can too. It's an absolutely amazing book. You can actually go and check it out if you actually want to. He has a paperback version and a Kindle ebook version. If you want to read a good book about investing, about how you can develop an investing mindset, building a solid framework, and how you can really start your journey in investing in a proper way, in a proper visionary way, then I'll recommend you to read this book by Eugene. Eugene, you want to share anything about the book, like, and why you love it so much?
Yeah, I think when I was trying to do it, I was trying to find a book that could really encompass everything, and I think this book is great for beginning investors, even somebody who has been investing for the long run. It's really mindset shifting, and the methodology. Investing it's not about giving you the fish. It's about really giving you the fishing rod and teaching you how to fish. That's extremely how the way of that, right? I can give you a stock, but if you don't have the confidence and the stock drops 30%, you're going to sell because you don't have the conviction. But what I'm trying to tell you, build that knowledge, build that strength, and leverage upon it. And the book gives you a very good framework about building that psychological mental mindset, and also explaining why we do certain things for reasons, and also giving it's very data back supported, and then also giving a framework of how to look at how to invest in companies. So hopefully, everyone can invest better. Everyone can invest in a portfolio that reflects your best vision for our future. And I think that helps we can shape the world for the better.
Fantastic, guys. If you want to actually get the book, right, again, this is again, you want to get the book, no problems at all. You can actually go to the link bit.ly/vision invest and get a copy of the book, right? You can support Eugene and his book Vision Investing. All right. So anyways, guys, thank you very, very much, Eugene, one more time. I really want to thank you so much for sharing your story, your inspirational story, and I wish you all the best in your investing journey. May you continue to trump the market, and may the markets be ever in your favor.
Thank you so much, Resh. Thank you very much for inviting me to this. Really appreciate it.
No worries. So guys, again, I think one of the things that is fantastic today that he actually shared was, buying, holding, and adding on to excellence and selling mediocrity. One of Eugene's key frameworks in investing. Guys, I hope you get it drilled in you. Make sure, most importantly, that you invest safe. Add to your trenches. Make sure you add to your winners. Right, sell your losers, cut out the weeds is very, very important. Tomorrow the market is closed, so we won't get to actually trade the markets. It's a good break, right? But on Tuesday, right, again, if you need to revamp a portfolio, you need to actually cut out some weeds, make sure you actually consider doing so this week. All right. So again, I want to wish you all the best in investing, guys. And tomorrow, as we start the new week, I want to pray that, hey, you guys get plenty of favor and blessings chasing you down. Right. So have a fantastic week ahead, my friends, and all the best. Have a great week, and I'll see you again very, very soon. Take care, guys. I hope you guys enjoyed this interview, and I'll see you really, really soon, guys. Bye.